Buy to let. Should you do it as a own name or limited company? Let's discuss. My name is Manda Walker. I'm a mortgage coach, and I believe that everyone has right to their own property. I say property rather than home because you can decide to be an investor. I was in the hairdressers the other day, and there was a lady that asked my advice because I'm a mortgage advisor. And I was like, "Oh, is your son planning to move out?" And she was like, "No, he's going to stay living at home, but he's got all this money and he's happy living with his parents, but he wants to use his money rather than leave it in a savings account. He wants to invest it, but he doesn't know whether to invest it as a limited company or invest it as in his own name." Now, basically, there are pros and cons with both. Now, if you invest it in a limited company, you obviously have to set up the company. You have to make sure you have the right codes. There are SIC codes, and basically whenever you set up a company, you have to put what the criteria of the company, what the company is going to do, what it's going to trade in, and you have to make sure you have the right codes. A lot of banks, when you're actually going to apply for a mortgage, if you've decided to make it a limited company and to trade in property, then they ask you to make it a special purpose vehicle, or SPV for short. So that's one thing that you need to know. The second thing is it can be expensive, time consuming. You also have to do your company accounts based on, yearly company accounts, make sure you pay your taxes on time and do your returns and all of that kind of stuff. So there is more admin for a limited company. And if you miss these deadlines, then you can get fined, and so you really need to be on top of your paperwork or pay someone else to do it, which also adds to the expense. But the pros of this are, if you decide to get your mortgage on an interest only basis, that interest will be classed as a business expense, so it can be deducted against the rent. So basically, if you're getting £1,000 a month rent and you're paying say 250 on your mortgage, interest only, the interest only portion is a business expense. So then you take off the 250 from the 1,000, which would give you 750, and you'd be paying tax solely on the 750. And then if there's any work that needs to be done on the property, some of them are business expenses, so you can charge them and get a bigger reduction on what you actually have to pay on tax. So that is one good thing. Another con is the interest rate on limited company buy-to-let mortgages is higher than on own name buy-to-let mortgages. That's something to bear in mind. But as you can deduct the interest, as I've already said, as a business expense, it kind of, as long as you've got the money to pay every single month for the interest, for the mortgage, then it's not a concern because you do pay less tax. But at the end of the day, there's a big difference between profit, i.e. the money that you get after you take off your income minus your expenses, that's called your profit, as opposed to your cash flow, as in the money you need to spend every single time in order to pay the bills. So, it's great having high profit, but if you run out of cash to actually pay the mortgage every month, then it doesn't really matter how profitable you are because you can't keep the money afloat. You can't keep the company afloat because you haven't got enough money. Hope that makes sense. Now, if you bought in your own name, that would mean that you would get the stamp duty exemption because you're buying it in your own name, and at the moment it's 300,000, so you wouldn't have to pay any stamp duty. The other thing is the interest on the loan, the buy-to-let loan interest for an own named is also a lot lower, and there are a lot more lenders out there that will lend when you're buying it in your own name. And the other thing is you only have to do your tax, you only have to do your self-assessment, which if you run your own company you should be doing. As you are self-assessing, you just can, if you're an employee or a self-employed individual, a sole trader, then you may be doing your own tax returns. If you're an employee and you don't do your own tax returns, you just use your P60 plus this and add on your self-assessment. So the self-assessment has to be done annually, and the deadlines for this are when the year ends in April, you've got until September to file a paper version. You've got until the following January to file an online version. And it is very straightforward. And the majority of landlords that have properties in their own name do their own tax returns. So, of course, there's lower costs with accounts. The cons are it is in your own name, it's not in a limited company, so you do take all the liabilities on yourself. They're not limited to the company. You also don't get the exemptions from the tax, so the interest rate we talked about that was a business expense in the business isn't seen as a business expense there. So for the same example, you get paid £1,000. Your interest is 250. You still have to pay tax on that £1,000. Now, in some circumstances, they will, if you're a basic rate taxpayer, they do give you some tax allowances, but every single year these are being reduced and reduced to the point that they'll no longer be there. So that are the pros and cons of both. So at the end of the day, what do you think is the best thing for you? I'd love for you to put in the comments and to let me know what you prefer to do or what you have done. The other point is, or the other idea is, you could do it as a limited partnership. So if more than one of you is thinking of buying property, you could do it as a limited partnership. Or what you could do, what some people do, is like the mother and the father will have shares in this limited partnership, and then the children will have shares in this limited partnership. Now, while the children are sort of young, their shares will be non-voting, so they have shares in the company that own these properties, but they can't actually make any decisions because they've got non-voting shares. But then later on down the line, you can actually trade up shares, and as they get older and you want them to have more responsibility, you can give them voting rights of the shares. And then that way, when it comes to inheritance tax planning and things like that, because you all own a part of the company, it's more tax efficient. So I'm not a tax specialist, so I can give you an overview of all of this, and I have got a pretty good idea, but it's best for you to seek professional tax advice. There are tax specialists out there that can give you a much better understanding than myself. I can give you a rough idea, and I know basically, the pros and cons of each type, which I've laid out to you, but it really is for you to do the research and be 100% sure. I mean, the main things to understand is how much can you afford to do every single month, because you've got to look at your cash flow. How much do you want to make at the end of the year? I mean, a lot of people have income in properties, but they don't actually take it out of the business. So if they don't pay themselves anything and the company is just earning all this money, then you'd have to pay corporation tax, but you wouldn't have to pay any income tax on top of that. It could just sit there. So that's also an option. I did hear an option about people buying properties through their SIP pensions. Again, because I'm not a pension specialist, you would have to seek advice on this, but that is another way of buying properties. But at the end of the day, I always think that properties are a really good investment, because interest rates for savings aren't that high anymore, and you can, as long as you've got the right property and you've got enough income, as I said, you're getting enough rental income and the mortgage is low enough, then you really can make a difference. I mean, some people, I have had clients that wanted to go capital and repayment, so they are actually paying off the mortgage of these investments because they want to own them outright in the end. Some people just prefer interest only because of the tax advantages, as I've mentioned before, when it's a limited company. So you really need to decide what the long-term plan is. But I hope that gave you an inkling and an idea. And what do you think? Should it be own name, or should it be limited company, or should it be limited partnership? It would be great to get your opinion on this. Let's start a discussion. So as I said, I'm Manda, the mortgage coach, and I'll be speaking to you again very soon. Thank you.